Okay, 25th of January, Rudy here. Welcome to a special edition where we're going to delve into fundamentals of oil and gas and shares, after that, shares and ETFs on the ASX and US, which can get you exposure to them. And I've chosen oil and gas because, unlike other commodities like gold, silver, copper, etc., it hasn't broken out. So it's usually best to buy things when they haven't broken out. Just buy, sit and wait. Okay, so first of all, what's oil used for? So transport, so planes, trucks, shipping and cars. But electric cars, really, we don't need oil. Well, I think here in Australia, charging stations, if you drive around the country, aren't that crash shot or vandalised. Globally, government subsidies are being withdrawn, for buying them to make them look attractive. Here in Australia, they're looking at we're looking at a road user charge for EVs, and my take of it is people are probably opting for the hybrid, the half-half option if they're going to buy a new car. Tell me if you disagree. Now, I'm not anti-electric cars, and we do have an ETF which has exposure to what's needed for electric cars, and we'll have a little look at that a bit later on. But you just don't want to back up the truck on one thing, and that one thing being oil's dead. So 20% oil for feedstock, chemicals, fertilisers, etc. 10% for home eating, and 10% for industry manufacturing. Okay, I've got a few little exhibits for you. So Exhibit A. So this is back to the 1800s, 1900, 2000. So oil, gas, coal demand. So as you'd expect, to get more people in the world, people coming out of their little village, wanting to buy all the new things, get themselves a motorbike. Ladies get some makeup, get them some rubber thongs, some plastic thongs, some raincoat. Anyway, you get the gist. Total US oil inventories. So this is back to 2001 to now. And if you don't know, China is trying to build a 2 years supply of oil, because they understand, they're not dumb. You can't run an industry on solar and wind. You can certainly run an economy on selling the stuff to Mr. Western man. Okay, and I like these types of ones. Bullish oil bets. So this is so no one's bullish on oil. So usually that's the best time to be buying something. For those of you who follow the old Rick rule, that's what he likes. Actually, I think Rick rules. He's been loading up on Chevron. But again, I'm not saying load it up. I'm just saying you should have exposure to it. Okay, so let's have a look at the charts already. So long-term chart. So back from the 2000s, got up to $140. There's our it's a declining, descending triangle really, but we'll get into this. So it's broken out, and it's coming back and doing a retest and forming another little another little descending triangle. There we go. That's a bit better already. Let me just show that again. So there's our monthly chart, and we've broken, we're coming back and we're doing a retest. We've got another declining channel here. We're finding a good support base here. Another declining channel. If you've watched the channel, you know that breaks of channels that are declining are bullish, but it's got to break it first. This is last week's candle, shooting star, which typically signals a top, but not always. So in case, usually you need that candle at the top of a range, something like that one there, which is at the top, and that usually signifies a top. But a top at the bottom, if it's broken, is bullish. So everything's setting up for oil to look quite good, especially long term. All right, so that's, oh yeah, and I should, over in America, they need $50 oil to make a profit. So if oil prices drop below 50, they'll stop looking for it because it's not worth their while. Now in terms of, this is just why, so I'm still bullish, electric cars, solar panels, all that stuff, and we have exposure, if you don't follow the channel, this ETF XMAT, which gives you copper, lithium and silver miners, global ones. So, you know, so it's not anti all that stuff, and you can have it in your belt. Okay, so back to the thumbnail. So what we do is we take the US oil price and we divide it by the S&P 500, and it gives us this relationship. So back to the 1915. So going up means oil's outperforming the share market, and then vice versa. Oil outperforming, and then share market outperforming. And you can see we're at the bottom of the range here again. If we go to a weekly chart so we're in one of these declining wedges, and we haven't broken it yet, so it's not confirmed, but you know, you look at this historically, you'd say you're buying somewhere near the bottom than the top in comparison of oil to the share market. Okay, natural gas. So what's natural gas used for, Rudy? Well, according to, this is what the rooster told me, 40% electricity generation, 30% manufacturing, 20% buildings, 10% transport. So that's natural gas. Now one of my theories is this one. So what happens when solar and wind don't provide enough electricity? Oh shit. So gas, natural gas is a good alternative if you don't have nuclear, which we should have, but you know, everyone thinks you'll get 3 years three eyes if we do that in Australia. But anyway, we shut down. You just can't. If we decide we need gas, you just can't turn it on because it just doesn't work that way. I had this. This is from a subscriber before, from the McChook farmer. Hey Rudy, remember natural gas is so much more valuable to humanity than just burning it in stationary turbines for electricity and heat. The Harbour Bash process combines natural gas, water, nitrogen to make ammonia used to increase yields around 50% of the world's crop. We wouldn't be at least 8 billion people without it. Hear, hear, Mitchell Farmer. So, alright, onto the price charts. So again, where, historically, so when you can go back to the 2000s here, we're at the bottom of a range, and we've had our declining wedge, break, come back, retest, support, and this is last week's candle. That's just ridiculous. Anyway, I think a lot over in America with those data centers, they're going to be using a lot of gas as backup. Alright, so that's fundamentals of oil and natural gas. Okay, so let's go to the shares. So we start with Karoon. So Karoon's 95% oil. They don't hedge, so they accept whatever the market's giving them. I've got this production score concept. So you take their market cap and you divide it by their millions of barrels of oil produced each year. So these guys are the cheapest, we'll find out, 0.1. They pay a 4% div, 50% franked. I haven't given it a buy arrow yet. I'm just waiting for it to break here for confirmation. But that's got a nice little wedgie going on there, so I'm sure that will break to the upside. Okay, next we've got Woodside, who happens to be David's pick in the category 2 of the channel's stock tipping comp. So we'll just blow it up a little bit. So Woodside's 40% oil, 60% gas. Now with a lot of them, so of that gas, 30% sold at the spot price. So that's that chart we were looking at before. And 70% is done at a contract price, which is linked to the oil price. So in other words, that spot price can go up to $1 trillion, and it won't make a difference to their revenue on this part of the contract, because unless it needs the oil price to go up for them to get more. Hopefully that makes sense, because it explains like why like Woodside 60% gas, why isn't its share price like doing that? That's because oil price isn't doing anything. But obviously as the oil price goes up, then they get more for their gas. Okay, so their production score's 0.22. So a bit more, so they're more expensive than Karoon, but you get that with bigger stocks because they command a premium. Of all their production, 25% is hedged, and they pay a lovely 6.9% fully franked dividend, with a commitment to grow that by 50% over the next 5 years. So they're a bit more divvy focused. Alright, so you can get him in your Australian Super, Host Plus, be self-directed. So I've had a few goes at Woodside in the past. So whoever bought theirs under the water. This is just my opinion too, not financial advice. So we've had 1, 2, 3, 4, and then this is going to be my last buy arrow because I'm not going to chase it up here. So I think Woodside's good to go now. Then we've got Santos. Okay, so Santos, so they're 20% oil, 80% gas, so a bit more gas than Woodside, but they got that same sort of issue, a mix of spot and linked. They're on the same production market cap to production score as Woodside. Less hedging, so their revenues are going to be more affected. So will go up more than Woodside if the underlying commodities go up. The div's not great. Well, it's better than a bank, 5.5%, but only 10% franking. Okay, so now Santos, I've never given him a buy before, as you can see, in the history of his lifetime. But this week I have. If you can do it, you probably need to do it now. You've got a nice declining channel there. I'd like to see a break, and I'd like to see a break above 670 for confirmation. You can get him in Australian Super. Now, what I like to do if I'm like trying to work out, should I buy this one or that one, is do a bit of a ratio chart. We want the ASX Woodside, not ASX. Okay. So this is interesting. So this is the ratio of Santos over Woodside. So historically, like since the 1990s, Woodside has been outperforming Santos. Okay, because as that number hopefully you understand numerators and denominators. Here Santos is outperforming Woodside, and then Woodside outperforming. Now so this is setting up a continuation pattern for Woodside to outperform Santos. Like that's the long-term trend. But currently, if that was like a share by itself, you'd probably buy that, which implies Santos is going to outperform Woodside. So if you're buying them for capital growth, you'd buy both. If you're buying them for a dividend, you'd just buy Woodside. Okay, Beach. So Beach is 70% gas, but their pricing is more Australian and local. Woodside and Santos sell at a global LNG price. And oil 30%, 0.25, so that you're paying more in market cap. But a nice div, 7.7, fully franked and no hedging. So as the oil price goes up, they'll get the full benefit as opposed to Woodside and Santos. I've had 2 goes at them. So they're at support. And the good thing about buying at support is like if the share price drops below, you just sell and you wait for it to come back and get back in again, rather than buying it up here and then it crashes. Okay, so Beach. So if we trying to do if we do another little comparison. So this is Beach over Santos. So this is forming a bit of a cup and handle, which is broken, is bullish, which means Beach outperforms Santos, but it hasn't broken, so it's not confirmed. And looks like it wants to come back down and retest, which means Santos is going to outperform Beach. But I'd probably be in the bucket of whether you want dividend or growth. So if you want dividend, Woodside and Beach for the dividend, and growth, Santos and Beach. Not financial advice, of course. Okay, then we've got this star here, Horizon Oil. Basically all oil production, but 14% div, no franking credits, a higher production score, so they're expensive. But look at that, no volatility chart. How do they do that, Rudy? Well, basically these guys are the masters of hedging. So they've got no debt, and they're small and nimble, and they basically make it their business a bit like a dividend play. They want to, so they're pretty keen on paying this dividend consistently. I thought I had. No, I don't. Sorry. They're pretty keen on keeping that dividend consistent, and they hedge their sales to reduce volatility. Hence that picture there. So again, that's if you're after dividends. Okay, then we've got Origin. You can get him in Australian Super. 5.2% fully franked div. Now, so 65% of their profit comes from their share of the APLNG's net profit. So basically selling gas to Asia, mainly Japan. But again, that revenue is linked to oil price concept. So again, a rising oil price is good for them. And then most of you probably know them for their selling gas and electricity business. So they're good too. And it was interesting because that's a pretty consistent sort of chart there. People probably don't realise most of their money comes from this, and thinking they're just buying a AGL type thing. Because if we compare it to Santos, we got the wrong German ORG, we want ASX. So this is comparing Origin to Santos. So that's showing, well, there are periods Santos outperforming, and I would expect that to happen. But at the moment, Origin's just, when's that? Since 2021, share price has been outperforming Santos. So there's a bit of a case for depending on what, because they're pretty good. That's a good dividend that they've got there. 5.2. It's probably just not backing one of the horses, but hopefully I've given you enough to make a decision. Okay, so we've got the picks and shovels. So these are companies involved in helping our oil and gas mining companies do stuff. So we've got this little small cap. He's only 70 mil. But you can see he used to be up at $1.80 back in the days. So he's now just breaking out. So he was a buy. I'm going to do him just on the breakout. Actually, probably should look at the month. So that's pretty nice monthly chart. We've got GNG. They're a bit bigger, 700 mil market cap. They do pay a div, 5%, fully franked. Again, in that sort of space. They look like they're about to go through to the next level. And then we got the big fella Worley. So they're global engineering, sort of specialising in oil and gas. They did a foray into the green energy scam and lost money. Lesson learned. Anyway, you can buy him in Australian Super, and he's in the tank. Hopefully, if you don't know what the tank is, subscribe to the channel. He's your core holding. If you're in VAS or VGS, get out of it. Okay, then we've got a few little gas producers. So we'll just go to okay, in order of cheapness. So we've got the score again. So they've got a score of 1. It's different scoring to those. So just reset, refresh. It's this spike. They did a deal. They're going to sell gas to Origin. But I reckon they're pretty. There's that declining wedge break. I reckon they're good to go. CTP, they're the next cheapest. So these are all gas producers. I'd like to see him break before confirming, or you could probably just buy, if you're going to buy all of them, just buy now, pretty safe. QPM, they're on a score of 2 as well. I've had a few goes there. That's anyway, you get that, and that's my second go. So that looks like he's ready to go. Q, a bit of a Horizon story there, isn't it? Oh yeah, they're the ones that. So they're trying to consistently pay a dividend. They're another one, 13% dividend. Small cap, but they're doing the right thing on the share price. Then we've got STX, so they're a lot, they're bigger market cap, a lot more expensive. Expensive doesn't mean bad. It's just something to keep at the back of your mind. They've got the declining wedge, but they haven't broken yet. So I'd say they probably will. So a break above there would confirm a buy. Then we've got PVE, even more expensive. But again, they're all producers. He doesn't pay any divs, but he's got a lovely rounded bottom, and the rooster loves rounded bottoms. So that's still a buy. That buy still exists. Okay, so that's the shares. Now in terms of ETFs, so we got the fuel ETF. So it's basically 35 global energy companies. It's not a great dividend. It is hedged in Aussie dollars. So if the Aussie dollar goes up, it doesn't. It's not negatively impacted. But it's got the big boys in there. So Exxon, Chevron, Shell, Total, Enbridge, Siemens, Conoco. Nice weightings. So we had that as a buy. It's well, I should give it that'll be my final buy, because I don't. That was the first one back here. That was a pearl already. So if we look at Exxon, Chevron, so you can see they're all breaking out. Shell hasn't broken out. TTE, that's a ripper. See that wedge? There's the wedge to break, go, bang, and then Enbridge. So they're all looking good. So that's ETF in Australia. And over in America, I like this one. This is 8% div on the ETF. With a lovely breaking from a ascending triangle there. So it's got companies like this, Wes. So this company actually pays a dividend of 9. So they're like in pipelines, transporting oil and natural gas around America and probably Venezuela in the future. Plains All American, they pay a div of 8.5. So the other thing, if you actually are buying over in US and you don't buy the ETF, you can go and just buy the individual shares. Anyway, so there's that ETF. This one's been an old one, Oil Services. So these guys will do well with Venezuela because there's a whole bunch of work I probably wouldn't there. I'd be putting that on the watch list for a pullback. Okay, then there's this, you can see we're at the bottom of the cycle here, the PSCE. This is your small cap oil and gas in America. But preference is probably this one here, which is your small cap. It's on the TSX, small cap Canadian oil and gas producers. That looks like a ripper of a chart. And I think that's it. All right, so that's your oil and gas wrap. If you got some value, give us a like. The Rooster is putting tough criteria on me to get 20% likes, so please help me out. Otherwise, I'll be in trouble. And give us your feedback on your thoughts. All right, see ya.